Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, August 13th, 2019. This will be a brief recap. I did a earlier video today for members of the site, and on that I actually we're going to follow up with this video after wrap this one up, get it out to everybody. I want to do an update on several things, such as some of the commodities I'm watching now: wheat, coffee. I want to look at treasury bonds, crude oil, natural gas, and marijuana stocks. So I'll try to include those all. They've all been covered on the site recently, but I want to do updates. So again, that'll follow up in a separate video for subscribers. This is end of day market wrap here. And again, a lot of just follow up to what I posted earlier today. So starting out with that, earlier today, well, the news today, if you're just catching up, was the markets were poised to open flat. When you look at futures today, we were looking at flat to slightly down open. And if you recall, yesterday we did a perfect back test. Here's the story here is QQQ made a perfect back test of last Monday's gaps right there. Very, very important technical support level. In my opinion, numerous tests there. And so, as I had mentioned in recent videos, even I think even in yesterday's update, don't be surprised. There's a very clear MO that's been going on lately, where Trump talks a tough talk on trade wars, the trade wars with China, and then as soon as his baby, the stock market, starts to come down, and especially I have very little doubt that it was strategically timed, but it doesn't matter. I don't believe, and I'm going to get to that in a minute, I think this is a one-off pop that is likely to be faded. But where it came is right at the open today, and then just shortly after the open, if you look at the 1-minute charts, it's when there's a market open right here. You zoom in. Here, let me show you. And then, boom. Little drop down, and all of a sudden the news that the White House is going to back off and postpone a lot of the tariffs that were set to go into effect here on September 1st, and also reduce some products there. So that set the market, that set the tone for that sharp pop. But let's talk about what it is and what it isn't so far. It's certainly a strong pop, but number one, in the video earlier today, and I've mentioned this recently, the biggest one-day gains in the market, when you have these big days, they almost always, with very few exceptions, and probably zero exceptions, the biggest gains in the market come during corrections and bear markets. That is a fact. That is not opinion. It was, I've said it many times. It was even written in the Wall Street Journal the other day. So once volatility expands during corrections, that's the nature of the beast. A lot of short covering goes on. Volatility is up. So number one, take that into consideration there. Now, earlier this morning I posted, when you zoom in tight, we were starting to, I had gotten back, I had actually left for a dentist appointment, I had a 9:30 dentist appointment. Markets looked to be opening flat. Was very eager to see, if we got into those gaps when I I checked it while sitting in the chair, pulled my phone out and saw this. Now what happened, so when I came home I posted, right here we had potential bull flag patterns forming. I pointed them out. I also made it clear that I didn't expect them to play out, but it's certainly a possibility, and one you'd have to respect if it did. A bull flag pattern is you have three components: an impulsive leg up. It doesn't have to be a single candlestick. Again, we happen to be looking at a 60-minute chart, so that's why you have one big candle. It took an hour to do that, followed by a period of consolidation. I think something that a lot of traders fail to do when looking at a chart pattern is confirm, do the volume patterns confirm? Because the nature of a bull flag pattern, it's a continuation pattern, number one, meaning you get the consolidation in the middle, the flag, and then a breakout. And the flagpole, or that sharp move up, should occur on high volume, with the formation of the flag occurring on diminishing volume, followed by an impulsive breakout, again on expanding impulsive volume, and a move. The measured target is simply the flagpole, length of the flagpole added on to the lowest part of the flag. Now again, so I said that's certainly a possibility, but I didn't expect it to play out and favored the pattern failing. Now what happened is there was no resolve today. We started going sideways, and eventually that pattern morphed from a bull flag into a potential bullish pennant, which is a close cousin, has the same net effect. but that didn't play out either, as I suspected. So what we did is we just traded sideways all day. I can say this now with certainty. I don't know, I can't promise you which way this goes. I'll tell you where I think it's going, but there's no more bull flag. That's much too long. A bull flag should not be nearly as long or even half as long as the flagpole. So that the symmetry for that pattern is over. Of course, again, and that in no way doesn't mean the market can't go up or it must go down. It just means those flags have now been foiled. Now, I say this often, it's the most bearish thing is if you have a bullish chart pattern, like a flag, bull flag continuation pattern, and you have a failed breakout. It starts to go up, and then boom, you go down. That's pretty bearish. The second most bearish thing would just be that the pattern simply doesn't play out. If you have a well-watched pattern, in other words, it's on the onus is on the bulls to take that and run. For the longs to take the breakout, gun it up, squeeze out even more shorts. So that's what happened today. The tweet, it coincided. There was a bounce off support. You got to give it that. That the gaps never gave way. That was our next sell signal. If you didn't catch the recent updates, there were three things I was looking for recently, or actually back it up a little farther, 4. Number one is we've came up to our, from a few weeks ago I had this max bounce target, had a bounce target zone that ran from right up there, 188.37, all the way down to the bottom of the gaps. So it had sell signals here, clear sell signals, and a back test. There were 2 great shorting ops, and then when we came down here, said, look, we're odds favor a bounce here, and this is where I think we bounced to. We hit it there last week. So basically today, look, we printed a close of 188.45 versus my bounce target zone of 188.37. 8 cents on $120 or $190 security is basically flat. That basically, for all intents and purposes, we closed right on that upper bounce target zone. And as I said earlier today, this is what I refer to. I have a term I made up called a momentum fueled overshoot. When you have a lot of momentum or upward velocity heading into a resistance or support level, it is more than common that you will overshoot and then come down, and that's exactly what happened. So that all this tells me is that level is still a very important level, as it was back then and it is now, and so far we didn't take it out. Brief pops below, and if you go right down to it, back on it, that means effectively we shot up and made a second test of my upper bounce target zone. We did so putting in some divergences here on the 60-minute chart. We'll get to the futures in a second. And SPY, same story. SPY looks almost the same. If you take everything away here, let's get rid of those lines and draw it out. So there's your impulsive move right there, your flagpole. That was, an ideal pennant at this point. Getting a little long in the tooth. If you want to stretch it, and again, just because it's longer than it needs to be doesn't mean that we can't break to the upside. It just isn't a very clean bearish pennant continuation pattern anymore. You also have, as you do on QQQ, this marginal new high on the SPY was a divergent high on this 60-minute chart. The bottom line is my outlook hasn't changed. And the fact we had this big green candle, as I said in the earlier video today, I used the example. When you go out to the SPY daily chart, remember the S&P 500, which today, by the way, closed below where we peaked out back here, back when the trade war started. They started a little bit before that, back in September. We're basically right back to there. And so what I said is, I don't dismiss a big green candle like that out of nowhere. In fact, at this point in time, we had a high here, major top in the S&P. We tested it again and failed. We tested it a third time. Then we broke out right here. Let's just say, and it didn't happen, but let's say we did not have negative divergence and we were not overbought. Those were 2 of the main reasons that I said this breakout would most likely fail. Breakouts to new highs that occur with divergences, negative divergence, and overbought conditions have a much higher rate of failing. So number one, we've certainly failed. It took this long, and that's where the breakout failed. Now we're back testing that level. But my point was, back here, had we not had the divergences, had we not had the overbought conditions, and we had a big 1.5 was higher at the highs. A big green candle like today's on the breakout, that's a breakout I'd like to chase. I like impulsive breakouts. So in other words, this candle wasn't a breakout. It just came in the middle of a near-term downtrend. When I say near term, yes, the trend off the lows right here is bullish. Yes, it's off the 2009 lows, it's bullish. So this is the intermediate term trend right here, still bullish. The long-term trend, you got to go back to 2009, and the short-term trend, that's why I spend a lot of time here on the 60-minute charts. At this point in time, it's still bearish. You had an impulsive leg down, pop up, but we're still well off those highs, and that's what I'm saying. This just came in the middle of nowhere, so it really there's not a lot of technical significance. Support held, but support hadn't broken yet. So we had that big pop, and we're back to resistance. So we're back in the middle of the, my bounce target range. We hit the bottom of it yesterday after taking it out before, or hitting it before, and then moving above. Hit the top of my target range, hit it again, and that's that. So I'll keep it pretty simple. We start going up from here, especially impulsive tomorrow. Close well above that level. That certainly will chip away at the bearish case. It is certainly a possibility, but it's not the possibility or the what I think will happen. So I'm just sitting tight on all the shorts I had, and again, that's the level where I said I would short up to recently on SPY and QQQ. Same story. All right, so those are the levels to watch, and again, it just kind of dovetails or picks up on where I left off yesterday, and that was the fact that we had. Recently, here, let me go to a daily chart and show you. There were 3 sell signals or check marks, if you will. I was looking for 3 check marks for the bearish case heading into this week and last week. So one here, I'm going to put it right here. Let's say that one's down here and that one's down here. Check mark number 1. I wanted to see this candle. We had that big candle from last week. What was it? Thursday's candle, big green bullish, as big as we've seen in a while. And I used some similarities to these candles back here in 2018, and said the first check mark would come if and when we faded that candle. That happened into Monday's close. We faded. So there's check mark number 1 came. We got it. Check mark number 2, I said, would come if we took out convincingly, not just a little 1.1 penny drop below. If we took out the last Monday's lows, the gaps, I should say, the tops of the gaps from that Monday's drop, not yesterday, a week before yesterday, last Monday, and we tested them yesterday successfully, and so far we haven't taken them out. So this check mark, we don't have it yet. And then the final check mark, of course, was the to break below the recent lows from week before last. So we're still pending those, but yet nothing's really been foiled on the upside. We still have that check mark of that candle being taken out. Yes, it was recovered today, so now this is even a more important battleground. So we just have to watch. This every tick higher from today's highs is certainly bullish and chips away at the bearish case. It doesn't, to me, it doesn't flip a switch that goes close all shorts, put everything in longs. It doesn't work like that. It just says, look, now, to keep a textbook scenario here for another leg down, you want to see us reverse at and below this level, which we reversed from last week. So that's it. And then, of course, those other 2 check boxes, yesterday's lows. Now let me say this, and I said this earlier. I think that it's a big if we can wipe out today's candle, that is a big green candle. It was, news induced, but it's there. There were trades made, and that's what it's all about. I would suspect if we wipe out that candle, and if we're gonna do it, we'll probably do it soon. To me, that would be uber bearish. It would be a get the hell out of Dodge signal. If tomorrow, the next day, the next few sessions, maybe into early next week, if we fade it, this was a big battleground between, bulls were happy and won there, shorts were dejected, shorts took back control, bulls had it today. So if we take it down and get that second check mark I'm looking for, we take out last Monday's gaps, the bottom of those gaps by quite a bit. I still think, as I said yesterday, we'll will start to waterfall, and we'll probably cut right on through those lows, those recent lows. So that's where we're at. So we're kind of back to the starting board where we were last week. But again, I guess the point I want to impress is, from a technical perspective, as impressive as a 2.2% rally and even higher at the highs than QQQ is, it didn't do anything to change the technical posture of the charts at this point in time. It could. It certainly could if we build on it, but as of now, no. Okay, member Kara885, Kara85 posted this in the trading room, and thank you for that, Kara. It is exactly what I believe I said it in last night's video and some of the other recent videos. To me, it's been a very clear, like I said earlier, a very clear pattern from the president, from the White House, where tough talk. This is called the trade war cycle. Administration's tough on trade with China. Toughest administration we've ever seen. Wow, can't believe Trump did that. Market sells off. Then all of a sudden, because the stock market is Trump's baby, that's how he judges his performance. He bases it on the stock market. That's a dangerous game to play. Oh, we'll see what happens if he can keep this market up for another year. Anyways, so that's that. It is, we are right here now. Every time, without fail, that the stock market starts to go down hard, or like today, remember, we were teetering at what I believe to be a very technically significant level that, if broken, would have triggered a cascade of stop loss orders, short selling, and other things like that. And whether I'm right or wrong, whether you agree with me, what you cannot argue is that Washington and Wall Street, it's a revolving door. Those guys come right out of the big banks, out of Goldman Sachs, right into Washington, back and forth. They've got smart people working up there. So the timing of it, to me, was pretty obvious. But again, you wouldn't know if it came today or they waited for the breakdown and gunned it. So I couldn't say. If I would have thought that we were going to get that release from the White House today, the news that they've backed off on the tariff threats. And again, we're right back here in this cycle, and it's been over a year now. And this is a very clear and continuous cycle. And all along, as I just showed you, the stock market has gone nowhere. We're right back to where we were, back around over about a year ago. So that's it. And so how far this takes us, again, let the charts be our guide here, but right now this is where we're at. And I kind of view it as I don't get the general public, sometimes that's the market psychology. You can't really get your head inside of the masses. There's just too many participants out there. But to me, it's a fool me once, shame on you. Fool me twice, shame on me. So I think at some point it'll be the boy who cried wolf, and the market's just going to do what it wants to do. And as I told another member today when I did the video, that one of the reasons, or I'm sorry, it wasn't in a video, it was before that, one of the reasons that I'm dismissive of these candles, not completely, again, a little more work, and it starts to, as I said, chip away at the bearish case, but it's not just everything I'm talking about, today's action and that whole the press release that came out, but it's going back here, things that I've talked about for weeks and even months now, such as the bearish engulfing candlestick last month in QQQ. You had this is a powerful sell signal, and it wasn't just a bearish engulfing like we had that kicked off the drop, that the biggest drop that the bull market since 2009 has ever had. The biggest drop came following a divergent high, negative divergence on the weekly. We had a sell signal that we zeroed in down to the day, almost to the penny, when tech broke, XLK broke. We had sell signals on XLK, just like now, like I covered recently. And so back then, we had the divergent high, the bearish engulfing candlestick on the weekly. You don't get those often. You don't want to look for them in the middle of a trend or in a correction, just at the end of a prolonged uptrend. And that's exactly, this was a very strong uptrend off the December 18 lows, ended the same way so far. Negative divergence, bearish engulfing weekly stick, confirmation, the confirming red candle I want to see. If you get a bearish engulfing and it's followed by a green candle, especially two, ignore it. It's just a little blip within a trend. So a lot of evidence here. And so that is why it really, as of now, hasn't changed, my near-term outlook. But again, here's the thing. We're right back to where we started, where at this point, I don't think it's prudent to add any more short exposure. And like I said today, I think, earlier on, you could have shorted today's pop right back to resistance. And you know, if you want to shorten after hours, it's up to you, or do whatever you want, with a stop just above today's highs. And you can ideally give it a daily close or a little bit above there, but if you want a tight stop, that's a very attractive risk reward, because although I won't share my profit targets, we have an official trade on this now on QQQ. You're talking less than 1% upside, and that's when we're, you know, the market's closed today. And you know, we shorted, you know, I posted as a short entry here today, objective short entry, just like back here. That was our last objective short entry. The really golden one was the back test of those trend lines. Although there were a couple, you know, things. There was a lot of that was also a news-induced move there. Okay, and a quick wrap up with the stock futures. This is NQ, the NASDAQ 100 E-mini futures, and you can see the all the lines here on the chart. Let me just draw the most salient points here. There's a lot of trend lines. Here's our divergent high, negative divergence on the futures, 60-minute divergence. The last time we've had negative divergence on the 60-minute charts was up here, leading into that recent high right there, the top to the highs. And that foreshadowed or preceded this big drop that we've had, biggest drop all year. And so far, or one of the biggest drops. We still haven't, you know, matched that last correction, but again, looks like the first leg down. And so most recently, you know, technically based, what happened, you know, of course, it was the news headline that was the catalyst to break out. You had this downtrend line right here on the futures. There was that level right there. We were flirting around this morning, but again, you can see the big green candle. And then if you look at it this way, you still have a pennant here. And it's actually a pretty decent symmetry on the futures when I look at this chart. Here, I'll zoom in a little bit for you. So there it is. So respect either way. You know, if you want a long side trade, take a breakout on the futures. You know, if it occurs overnight, you're not going to have the volume that you have during the regular session. Keep that in mind. So a breakout now might have to lack, you know, high volume, but you could certainly trade it that way if you're bullish, or watch for a failed breakout or a move back down below this recent area of consolidation that would send us lower. And then of course, more importantly, the recent lows, if we take those out, QQQ and SPY, if it's during the regular trading session, should then enter those gaps and give that next sell signal. So to me right now, it's all about you know, is this big gain today get faded or not? And so to be continued. I think it does, but well, we'll see. ES, similar, very similar technical posture. Here's the negative divergence. Let me clean that line up a little bit. 60-minute chart of ES, the S&P futures. There's your pennant right there. Big impulsive move up. That would be your, you know, measured target, roughly the distance to the flagpole. That would probably take us here. Let me zoom out a little bit. Remember, there's downtrend line resistance coming in off the highs. So if you're looking for potential upside targets, whether it's to go long and trade it up to that level, here it is right here. You have a downtrend line on the S&P 500 futures off the highs. It would come in, I'm just eyeballing it, it's going to come in a little bit lower than the measured target for this pattern, should that pattern break out. And that would be one area to look for resistance. There's also a lot of price resistance up overhead as well. So that's why I really doubt any breakout's going to go, you know, all the way to the measured target. But yeah, anything's possible. So same story. Bulls start to really chip away at the bearish case if we can get much above today's highs. And bears, if they can wipe out this big candle, undercut the recent lows, it should open the door for the next impulsive move down, something like this. Not this kind of guy. This is corrective type price action right here. Okay, let's wrap it up there and see what happens in the futures overnight and into tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.